Yeah. So, what we'll do is, again, we'll do quick intro. I'll set up the agenda and then hand it over to the experts. I think most of you know me. I'm Avan Vora. I think you might not have seen me before. You might have read my articles, but I am the founder of returningindians.com. And I think most of you must have seen my message on the group, right? We have with us a team of Total Finance. So Total Finance is a fixed fee advisory membership platform to address all your personal finance needs. They work with resident Indians as well as NRIs. So we have many people from this team. We have Raj Ahuja, who's the co-founder of Total, on the call with us. We also have Mukund, who's again the co-founder of Total. The experts, Shruti Srivastav, she's the compliance expert. She'll be going over some of the checklist items that you need to do after coming back to India. We also have Ankit Rungta, who's the international tax expert, who's going to sort of address your questions around 401k, and taxation, rental property, and the like, right? So the agenda is going to be they'll sort of do the intro, do the compliance checklist, the taxation tips. I've also sent all the questions that I got from the community to them. We've sort of summarized them into broad buckets so we can answer them. And towards the end, we'll also have live Q&A. If you have some questions that are not answered here, you can feel free to ask right towards the end. So yeah, I think that's the agenda. So over to you, Raj.
Hey, thanks, Avan. Um, Good morning, everyone who's joining in from from the US, and good evening to the folks who are joining in from India. We'll try to make this the second best session after while India Pakistan is on. So we'll not make it very numbers heavy, but there's surely going to be a few things that you're going to take back home. And obviously, the recording will help your friends and family members also around this. So I think while broadly Avan has communicated the structure and introduced us what we are doing, just a 2 cents on what Total does. In simple words, what we are trying to do at Total is trying to build a conversation first platform, which is more like in a non-finance analogy, think of us to be like a hospital where we have qualified financial advisors who are like doctors. On this call, we have got Shruti and Ankit to help you on matters related to banking, compliance, cross-border taxes. And on the other side, we cater to the needs of uh, discerning working professionals, Indian residents, as well as NRIs who are planning the homecoming journey. So that's a bit about Turtle. We'll talk more about Turtle as we move ahead. How we have structured the today's session over the 90 minutes is we have put together a few slides. We'll start a bit about Turtle. We'll flow this session into some of the parts which are critical from a banking and compliance point of view, which Shruti would cover. There are going to be certain questions which are shared by you. Some of the questions our team members have collected through their experiences over the years with different NRIs who have come back to India. We have put them all together. So we'll cover the banking and compliance part first. Shruti will cover that first, and then slowly we'll sort of segue into the cross-border taxation part. There also parts of it is content and parts of it is Q&A, and then we'll open the full floor for live Q&A. So without any further ado, let me get started. So moving countries is not easy. We all know, and a lot goes in our mind when we are moving countries. We are thinking about whether we'll be able to fit in back from the ecosystem we came once, how the future is going to look like. Obviously, the absolute pay reduces in terms of number, but is that going to be enough? How the career trajectory is going to fit in? How children and the family are going to settle in? And there are tons of things beyond finance that keeps coming in. Um, and when we talk about with respect to finance, we sort of narrow it down on the topic of personal finance or money. There are tons of questions again which are coming up in our mind about what should we do with our savings now that we have parts of our money in the foreign land, parts of our money in the Indian land. How should we go about managing our investments, our income, taxes, and more importantly, we are always seeking. I always say this to all my clients that content and knowledge has commoditized so much that at the end you need a conversation, you need that your go-to guy to answer all your queries. And that's where I think, because these are For some people, it is $1 million decisions also, like the most important decision in the life. So, if you would sort of relate to this, I want to know from the chat. We have a close to 50 odd people joined in. Are you worried about handling your finances as you move back? Um, you can sort of share a yes or a no or a thumbs up in the chat, and I think we'll get to read that from there. I think somebody yes. Okay. Yep. Yeah, so as I said, I know that's one of the primary reasons you guys are here also. So without, I think, talking a lot more about the larger scheme of things, let's start with picking up a topic today. I'll We'll begin with banking and compliance, first of all. The three stages: NRI, RNOR, and residency. And I'll let Shruti take the next few slides ahead. Just a quick intro about Shruti. She has been one of our banking and compliance expert. She comes with an extensive experience of 12 plus years, managed 700 plus clients, and pretty much wore hat over a lot of other things. Banking and compliance is just one of the armors in her, is one of the sword in her armory. And I'll let Shruti add more to her intro. Anything, Shruti, you would like to add, and then take it ahead from here.
Hi Raj, thank you so much everyone, and a very good evening to all of you. It's like a very honored introduction of mine, but yes, I'm Shruti Srivastava. I'm having around 15 years of experience in banking, compliance, especially in NRI and HNI segment. So I'm like ex-federal, was working with Federal Bank Limited, ICICI, HDFC, IndusInd Bank, and everywhere, fortunately, I have taken care of NRIs. So I don't know if it is a feather on my head or whatever, but it is like this, and that's the reason why I am here today as a banking and compliance advisor in front of all of you. I hope I will take you through the basics without going further into like a lots of details, because in general sense, what is important for all of us to know and to do to basically avoid the major complications which could come into our life. That's the basic thing. And then another, like going ahead, it depends on person to person, definitely, which chartered accountant or an advisor properly will be able to take care of. But in the general view, I will take you through. I will be really happy to take all the questions what everyone is having, and I'll try with all the knowledge and all what I have, I'll try to fulfill the requirements and answer your questions. So coming to the compliance checklist, basically what I feel is people are majority are having like how the financial relationship in India begins. So that begins with a savings account or a current account. So that is bank. Then coming to the other part, it never used to be. Earlier we used to, in India we used to know LIC only, but now fortunately we all are aware about lot of insurances. And also second comes to the insurer. Third comes the tax department, because yeah, I know that in India everything is known as like, we can do taxes, we can do jugaad, we can produce bills, but fortunately or unfortunately, we are one of the democracy where the things are pretty simpler. It's not as complicated as, like, I feel, that is my opinion, that for everything we have to go to attorneys. No, here from the hierarchy wise, if you will see, like, either it is bank or insurance or income tax department or investment or forex, we have, from the set of new nodals to grievances cell, then coming, if it is we are not heard over there, then we are having ombudsman, etc., etc. So in India, before, like, ultimately ending it to advocates or the courts, we have lots more places and a lots more time where we are actually heard. So that is the best part. The only basic requirement what we have to do is we have to comply with the process what is actually meant as a general public for us to be complied with. Second slide please. Coming to the next slide. A banker. Okay, so first one, thank you Raj. So at the bank, so once you are returning back to India, some people visiting visa, or you are working over there, or you have like lots of tenure which you have spent outside India and all, the very first thing what you have to come back, when you are coming back or when you are planning to come back, and when you are thinking that I will not be an NRE anymore, under that situation, the very first thing what you have to do is, it is called as the right to information, you can call it. Every banker, your insurance agent, everybody has this right to know where you are, what is your current status. So please write in writing, you have to inform your bank that you are no more an NRE or you are a resident now. So under that situation, what happens is, most of the cases, like, we all are having our own relationship managers, or we are into the long term relationship, or it's a small branch, because right now in India we are not into the branch banking, we are actually into the core banking. Core banking means like, maybe your branch is somewhere in Delhi, but right now if you are located in Hyderabad, you can just visit to any one of your nearest branch and you can inform them, you can give a request letter and the recent KYC saying that I am no more an NRE, I'm a resident, please update my status, address, email address, mobile number, whatever it is. So but in that case, most of the cases, practically what I have come across, what happens is, you give the request letter but don't take the acknowledgement. Now at that point, maybe that is not a very difficult situation, or maybe we just ignore it, uh, or we may be checking it later on, like 1 year, 2 year, 3 years later, only we will realize that okay, it has not been changed. Now how we realize it is, now in the core banking system, which every scheduled bank is having in India, you are having a single customer ID. Means either you are having a saving account or an FD or an FCNR or whatever, all the banking relation is linked to one single customer ID. So if you any change is done to that customer ID, it reflects everywhere. Like whatever product you are holding with the bank, it will reflect everywhere. But suppose you realize it that one account is actually has been changed to the status you wanted to residence, but second one is still NRE or NRO. The only fact you have to realize is that you are having two customer IDs. So in that case also you have to take the immediate action because of the various reasons. uh, why I am telling this is very important to take the acknowledgement back from the bank is, later on, suppose because of any problem or the bank has not executed your request, in such a scenario you should always have an evidence. If you receive a notice or a scrutiny or anything, or a department is asking, because in India holding the two status is actually comes under the non compliance, or you either you can be an NRE or you can be a resident in India. So to avoid all the complications which you may face later on in life because of the banker has not changed but you were at the right position in sending them the request, all this situation you can just avoid it, just because if you are having the acknowledgement received as on date, sealed and signed, that you already to inform the bank that you are a resident now. Second part, yeah, now coming to one more important thing. Till when you are an NRE, you are actually, NRE funds are always welcome in India. That's why none of the NRE deposits or anything is taxable. You are, till now you have must not have faced the issues like the TDS gets debited. You must be like I'm getting 7%, 8%, 9%, whatever interest, the full amount comes to your account and all, and you feel good about that. Now when the bank starts debiting the TDS, so TDS is called as tax deducted at source. When your interest income increases, like crosses 40,000 rupees of interest in a particular bank, they start debiting the TDS. So now when you are a resident, you may face this issue. Now you have a choice: either you feel like you are having lots of FDs and all and your income comes under the taxable income, which Ankit will take you through. So in that scenario you can allow the bank to debit your TDS. In case you feel like no, let my interest get to my account completely and whatever taxability will occur, I will fulfill it later when I'm filing my taxes. In that scenario you can please scatter 15G or the 15H form. So if you are below 60, 15G is the form, and if you are above 50, 15H, every quarter you need to go to your bank and provide this certificate. Now second we will take to the insurer. Okay, so now after banking, why it is very, very, very important to inform your insurer. Now, if it is an endowment policy or some policy where the maturity benefit or the return is there, in that scenario you need not to worry much, because what will maximum happen is, suppose you are supposed to get a maturity, but because you have become an NRE or you have become a resident, now your account status has changed. So whatever account is linked to there, you may not get the maturity in that. You need to change the bank account over there. But that is not a very difficult situation, because it's a matter of money. They can provide you the check, or you can update it to nearby branches and all, and your maturity amount will come with that. Important part is when we are having the term accidental or medical policy. So in this scenario, again, I will give you one small example. What happens is, a person was having a medical policy, he took it from Qatar. Now what happened, he came to India and he got a cardiac arrest. He got admitted over here and all, and then he filed it for the reimbursement, because it was a medical insurance covering the person internationally. But what happens is, because there was a lack of information, so his reimbursement, they said that we cannot entertain that, because there's a legal lack of information. We were not knowing that you have changed the democracy. So same is the case with the term insurance, because these two, accidental term insurance or the medical insurance, it's all the safety blanket for us. So it is very important that we are always, if we have taken something with the intention that our family and me should remain safe and all, it should be fulfilled and cater in the same way. It just takes a one email to you from your side, any of the customer care email, you can just email, receive the acknowledgement, just informing them that for the time period you are an NRE, or you are a resident, or your democracy, or you are on a project. So in that case, the coverage, they cannot tell you that your coverage, in case suppose there is some condition in which your coverage is not allowed, then also you will receive an email. At least you will be informed that this coverage is allowable or not allowable in the other democracy where you are in, or the other country where you are in right now. Income tax department, yeah, this is an information, like, earlier people never used to cater it more, or maybe like we were not, or maybe in India the income tax department was not issuing notice or asking people to declare it. But now what has happened is, if you are a resident in India, Aadhaar is compulsory. If Aadhaar and PAN is not linked, you are not going to get a return. Regardless of this, if you are an NRE, you need not to have an Aadhaar. Now, the complication comes where you have returned back here. This is just the situation. You have come back to India. You are not having Aadhaar. You are filed a return. You will not be allowed to file a return, first of all. So whenever you are either becoming an NRE or you are shifting back, in the back end, the status of your PAN changes. How to do that is, in your profile there will be an assessing officer's email address. You just have to write to your assessing officer with your recent KYC documents, declaring what status you are in and what is your taxable status will be for the ongoing years. This will again, the importance of all this, whether it is a banker or information to your insurance agent or information to the tax department, unless we really face the issue, we don't understand its importance. But I am just making you self-aware, because these all things, if you will see, we can avoid really long big problems which may occur later on in your life. Next. Now again, the same thing, if you are having the investments in India or the mutual fund. So SEBI is having lots of compliances for NRI, like they cannot have multiple PIS account or the NRO, or in the major cases people face really big issues with the brokers with non-information, or what happens if they are holding as a resident, now it cannot be changed to RNOR, they have to sell it and then shift the money to the NRE. Lots of things happens over here. So coming to the mutual fund, like the changing of the status, it is all CKYC. Just one you can visit. If normally you don't have a broker or you don't have an agent or anything, you can visit any K fintech office or a CAMS office. You can just update it and it is done. But in terms of stocks, you really need to be carefully understand this and take care of it, because again, the stocks you cannot hold. Like if suppose you are becoming an NRE, then again it is a problem. If you are becoming a resident, then you have to actually sell it off, because the direct transfer of the stocks is not available under this situation. So when you are actually planning this situation, you need to check your capital gains, check the accessibility, check how you are going to transfer everything, and then only take the decision. But again, information is really important. Now again, like again, mutual fund is having one more thing. Once you are becoming the resident, this all the sale of the mutual funds and all is not taxable, which used to be taxable for you. TDS used to get debit when you were selling the mutual funds earlier. Same is the case with the stocks. But again, take care of it, because the stocks, the mutual fund, when there is a lack of information, the department is actually sending the notices, because all these things are now directly tracked at the back end of our income tax portal. So nothing is hidden. Even if you are depositing the cash, either it is 2,000 rupees or a 2 lakh rupees, or how many bank accounts you are having, or how many stocks you are selling, everything is noted. So please take care of all these compliances, which is very, very, very important. Next slide, Raj. Okay, now coming to forex, many of us, like when we are returning back to India, we take the currencies and we come back. So there is pros and cons both of it. Like when you are holding the dollar, definitely it will appreciate in the price, and many of us, so some of us will take it as an investment option, that anyhow I'm having the dollars, let me keep it and sell it later on, dollar is anyhow going to appreciate. Some of us, keep it in a different account and try to pull it back when either it is like once you become a resident, all of this are considered under the income. So if in case you are planning a forex account to be maintained either in the form of a cash, or you are having any forex derivative or something which you are planning to get back to India, it is always better to bring it when you are holding an RNOR status rather than when you are holding a resident status. Repatriation of the fund, most of you must already be knowing, because you must be in the flow of transferring all the funds and all to your loved ones and all. Incoming is not having any issues. You can, like incoming and all, you can really bring in the funds anytime. You can transfer to your account, your relatives, your friends can transfer to your account. It is non-questionable. But when you are transferring to someone outside India, like from your account to someone else account who are settled abroad, means like Indian account to abroad account, then you have to go through few of the process. Like from the bank, from the chartered accountant, you require certificates, which is actually called a CACB certificate, and you require FEMA declaration, you require Form A2 from the banker side. And in the new budget now, like up to 10 lakh rupees, there is no tax collected at source, like TCS it is called as. So when you are transferring the money abroad, there is a part called TCS. So if in case it is below 10 lakh, there will not be any TCS which will get debited by the bank on the money you are transferring, total money you are transferring. If it is crossing, it will be charged as 20%. Again, on this, when you are transferring, other charges will be there, like banking charges will be there, forex transaction charges will be there, security transaction charges will be there. So it is always good to refer to 2 to 3 banks, or like Unimoney, Western Union. There are many more agents available. Whoever is giving the competitive price, it is always good to go through them. Last point, if you are wishing to hold the funds in the foreign currency, yeah, this is a very important thing which I wanted to take care of. Like, many of us are having FCNRs and we try to hold it. So I will give you a small example in this. Suppose you are having FCNR, if you are breaking before the maturity, there is a penalty over it. If you are holding till maturity, you cannot hold it, because as per rules you cannot hold it, because now you are a resident. So it is always good and always feasible plus highly compliant that you convert your FCNR to RFC accounts. This will protect you against the penalty or if suppose you are planning that you want that appreciation of the foreign currency and all, that will also be protected. And it is, if in case you are later on becoming the NRE, this can be directly converted to FCNR. If in case you are not becoming an NRE, this can convert to INR and come to your account. Again, the taxability is same for any of the income which is getting acquired in India. Next slide, Raj. A small checklist for all of you. Yes, to the banker, please update the custody as soon as you are here, or maybe previously to that. Information, taking the acknowledgement is very, very, very important. Please take the acknowledgement from your banker, from your broker. If you are an NRE and holding the PIS account, then it is no more needed. Please close your PIS account. You just require a demat and a trading account. No need to hold and no need to pay the AMCs for any of the brokerage account and all. Insurance company, please, it is very important for you, for your family. If you are shifting, if you are at a different place, please keep checking your term insurance and the medical insurance on, international coverage, or from where you have taken to other country. If not, there is lots of option where portability and the transferability is allowable. Please go for it. And tax department, yes, please write an email to your assessing officer informing him the status with the recent KYCs. So this was all from my side. Thank you so much. I'll welcome all the questions if anybody is having any questions in this. Okay, so I'll take through some of the questions which got posted here. First one, which type of income can be repatriated? Is there any limit on it? Okay, so any kind of income you can repatriate. There are three conditions to it. First one is, if suppose it is a sale of property, sale of stocks and all, the chartered accountant will give you certificate to repatriate the funds only if the Indian taxes are properly paid on it. Once the taxes are properly paid, you can repatriate any of the income, any of the savings from India to abroad. Is there any limit on it? Actually, if you will ask, there is no such limit and all, but if it is crossing 1 million USD and all, which is quite a big sum for anybody to transfer in a single year, then we require the RBI permission. So there is a particular form and we have to request RBI saying them what is the reason of transferring so much fund out of India, and you will be allowed. What are the basic papers I need while requesting AD to transfer my funds abroad? Yes, it is Form A2 and the FEMA declaration along with a request letter from your side, plus 15 CACP certificate. That will be given by your chartered accountant. What is the applicable TDS and TDS? How to manage if I'm transferring the large sum of money? Okay, so if you're transferring the large sum of money, the easy way to take care of the TDS is you can divide, from the multiple account and transfer. If from the single account you are transferring, which is more than 10 lakh, then 100%, 20% will be there. So you can to your spouse account, to your kids account and all, you can transfer, and then 10 lakh rupees of transaction you can take. This is properly compliant and valid. You can transfer to the single account outside India, but from Indian account, if you're transferring more than 10, then TCS will be applicable. So if you're dividing it into different parts and the different accounts, this can be easily managed. Next question, is there any? Okay, audience questions. Okay, which bank account can be maintained? Just give me a minute, please. Okay, which bank accounts can be maintained in the US after moving back? What's the recommended maximum amount I can leave in this bank account without risk? So coming to the US, some of the banks are pretty flexible. When even you can, from the Indian side, if you will see, you can definitely maintain a foreign account. But some of people, we have come across many of the issues where some of the banks has actually sent notices you are no more here. There is no activity in your account. So that is a very probable reason for them to send you the notice and tell that I am closing it and sending this money to the pool account, where taking out money from the unrealized pool account is very, very, very difficult. But some of the bank like Chase Bank and all are pretty flexible. So whichever location you are, you can actually refer to us, or we can provide you the exact. For that, you need to tell us which location you are in, and we will be able to help you in that. coming to like how much maximum amount I can leave without risk, that totally depends on you. There is no much risk in terms of like the maximum amount, but yes, once you are shifting back to India, you will not be there to take care of the funds. So this risk appetite you should be having, like how much money I can keep there so that I will be able to manage it. From the banker side, if you will ask, there is no such limitation, and there is no such big risk also if you are going with a good bank over there. People like they keep the money in the banks because they have earned it in the dollars and they want it to appreciate in the similar way. People hold it also. So if you are looking for the compliance point of view, there is nothing like a maximum limit as such. Second question, can I continue investing in America while I withdraw lump sum in INR? uh, Again, investing in America is always a good option because as compared to other democracies, us has actually worked well in terms of the dollar appreciation. Now everybody must be going through the news that rupee is actually becoming weak and all those things. So you can continue investing in America and keep withdrawing in INR. Now again, this is in the general view. I will not be able to help you much because we need to look at different parts: your status when you are becoming a resident, which all accounts you are holding in America, and the which all accounts you are holding in India. So I like, if you are an American citizen but you are now an Indian resident, then you know the compliances are different. But if you are still in America, you keep visiting and all, then it is definitely different. So suppose I'll assume that you are an Indian resident now, you can keep withdrawing it. If you are transferring it to American account, paying the taxes over there, and then getting to India, then you can withdraw in the form of SWP and all. If in case you are directly getting to the INR account, then it will be considered as your, you know, foreign income, and the taxability will occur on that. Third question, I didn't file tax in India for the past 7 years. I have only PAN number and don't have an Aadhaar. What is the option I have if I need to file tax? So for this, I took you like in the new budget, actually for the last 4 years, you can allow the tax. You can file the taxes from the 1st April, I assume. I think that has not come. Still, we are not able to see, but in the new budget, it has come that for the last 4 years, you can file your taxes. 7 years and all, you can file only if the assessing officer is allowing you or sending you some notice, or there is some compliance part issue and they are opening it for you. You can file, otherwise we can't. Coming to this, if you are an NRI and holding the PAN and now becoming a resident, please apply for your Aadhaar. That is very important. If you are still an NRI, then Aadhaar is not necessary. You can go ahead and file the taxes. How do I currently report foreign asset schedule to avoid audits? Okay, so the foreign asset schedule is available in ITR 1, 2, 3, 4, whichever form, whichever ITR you are going with in India. So there is a proper schedule and a proper form for that. You have to report your asset liabilities, what all foreign assets you are maintaining outside India. To avoid audits means, like, again, you have to be compliant with it. Like, you should be reporting what you have. If you are reporting it fully, you can avoid all kind of audits. Should I transfer the funds before and after returning? What is the best way to transfer money from US to India while minimizing the taxes? Best option, if you will ask, if I would have been at your place and shifting to India, and I will, and I am not going to go back again, and I am not there to take care of my things there in America. Of course, I will do it when I am in R status, not when I become a resident, because then foreign income will become taxable, not when I am an NRE, definitely. So, but this RNR status like stays for 1 or 2 years, depending on the number of days, which can be calculated by the chartered accountant and all, which we may help you if we can talk to you one-on-one, if seeing the situations and all. But best option, if you will ask me the answer directly, when you are in RNR status. So that is the best time when you want to transfer money. Any other question, Raj? Okay, can I keep some cash in the Fidelity account to buy USS? Yes, you can. There is no limitation and there is no restriction on that. Do I need to move all cash within my RNR, or I can do it later? Again, I already took this question in the last slide also. Best option is, yeah, you can do it when RNR status, because you get a rebate, like, whatever privilege you will enjoying when you were an NRE, same, almost same privilege you enjoy in RNR status. So it is better to move all the cash when you are in that status, if you are not planning to become an NRI again. So this is the best option. Is there a limit to how much I can hold in the US account? No, there is, compliance wise, there is no. Again, it depends on the bank where you are maintaining, the location, if it is very, in the island side and all. Because in India, on the lighter note, in India, if you must have gone across the Punjab Cooperative Bank, Yes Bank cases and all, you must have seen in India may, like, you can't, like, the banks cannot go off the market. They can't, because we are, that is the one of the basal norms, what we call, or we are having the pillar. It has always been guided by the government of India and the RBI, and investors' money are always secure in all the banks in India. But that is not the case with the US accounts. That's why I'm again and again telling, keep the funds which you are able to manage over there.
Shruti, I think just one clarification of RNOR.
Yeah.
When you say you should bring all the money back in RNOR, you just mean to say the ones, like, for example, if there are capital gains or anything else that you can do. But otherwise, if you just remit money later on, even in your resident status, it doesn't really matter, right? If there are no taxable gains or anything of that sort.
No, no, no. Aman, what happens is, no, when you are in the resident status, the foreign income is considered taxable. Like,
Correct.
you,
So foreign income will be gains or some sort of gains, right? Not the money that is sitting in your bank account.
no, no,
That
no, no,
doesn't
no, no.
matter. Yeah.
Personal savings, no. Personal
Yeah,
savings,
exactly.
no.
That was just a clarification. I think someone asked
Yeah,
on
yeah,
the
yeah.
chat, so I
Personal,
just wanted to
personal
clarify.
savings, you are transferring from your own account to this account, that is
Right,
not taxable.
right, right. Okay, I think we have a lot of
Okay.
questions on the chat. What I think
Yeah.
what we can do is we'll probably take it towards the end and get into the taxation part right now, so that we don't run out of time. We have tons of questions on chat. We can do that later on. Okay.
Sure, sure,
Correct,
sure.
correct. Correct. I was saying that only ki I think many of the questions I'm seeing on the chat will be covered in the
Yeah.
next section, folks. So thank you, Shruti. This felt like a crash course on banking and compliance. And we'll now move into taxation, folks. I'll sort of quickly introduce Ankit, and I think Ankit will sort of take it ahead from here. He's similar to Shruti, comes with a extensive experience of 15 plus years on matters related to cross-border taxation, and all your RNOR, residential status, real estate related, let's say rental income, dividends, taxation on those, and the favorite 401ks. IRA questions will be taken care by Ankit in the next 4 or 5 slides. He has sort of put together all the questions that were collected while you were registering. So yeah, Ankit, over to you, sir. Yep, I'll just go on mute.
Thank you, Raj, for that fantastic introduction. Thank you, Shruti, for this enlightening discussion and your details that you have shared that information. It's quite a huge amount of information right now to digest in a very short period of time. I'll try my best to keep this momentum running so that there's no fatigue that ends up on this entire session. So. And thank you, Avan, for this opportunity to, provide us this platform to, speak to so many wonderful people and answer so many questions as much as I can. All right, let's not waste more time. Let's move forward with this. Um, Residential status and RNOR. I believe most of us are aware about, how residential status is calculated in India, the number of days and the RNOR benefit that is available, once you are coming back to India for good. So just to reiterate, it's safe to assume that most of you are aware about this RNOR and residential status. So can we have an answer like yes or no or something like that so that we can, move forward with the next slide?
I think Ankit, if you can just briefly in like a couple of minutes just share what it is. I think few of the folks don't know what the status is.
All right. So So going by this slide, so let's say if in India you stay in India for 182 days in a financial year that starts from 1st of April to 31st of March every year. If that happens, then you are considered as a resident. If it is less, then there are other conditions like less than 120 days, less than uh, 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 60 days plus 365 days. That's another condition that is not mentioned over here. So if you fall into that and you're like based on that, then it is decided that you're a resident or a non-resident. So the best case scenario is like to calculate 182 days if you're in India, and if you're 120 days in case of an Indian citizen or a PIO who's earning more than 15 lakhs in Indian income, uh, except for like all the Indian income combined, if you are living in India for 120 days, then you are considered as a resident. But ideally, in a lot of cases, there are some other conditions for RN resident, but not ordinarily resident is basically RNOR. So there are a lot of other conditions involved, like 729 days in last 7 years, and last 2 years if you are a resident but not a resident. So based on these conditions, you qualify, you decide whether you are an RNOR or a resident or a non-resident. Now, this is a very, very important aspect. This is equivalent to, substantial presence test that you have in US, with the number of days calculation that we have over there and, we have in India. It determines whether you are liable to pay tax in India on your global income, not just with Indian income. So the residential status is the foundation of income tax, where you have to calculate your number of days to the precision of hours. Like if you are like, let's say if you are having more than 50 lakh rupees Indian income and you are having 119 days plus 23 hours and let's say 20 minutes, then you still become a non-resident. There are judicial rulings that favor us, if you are able to prove with the passport, you have that passport stamp, visa stamp in your passport, right? So through that you will be able to prove how many number of days you are in India, how you can calculate easily, and make out on your own like how do we do this, and then uh, decide like whether you're a resident or a non-resident. In case you are falling under the bracket or a bucket of resident, then it's like global income is taxable to you, irrespective of where you are earning that income. It doesn't really matter. Can we move to the next slide? So this is a brief, chart, so let's say if you're an NRI and from an Indian perspective, so you have to pay tax in India only on the income that is earned in India, like rental income or dividend income, or, if you are doing any freelancing business and your company is paying you in your US account, but the company is registered in India, on that income, you have to pay tax in India. But let's say if it's outside, Indian authorities are not bothered if you're residential, you are a non-resident. Indian authorities are not bothered to even check whether you are having any income, and you are not even required to file your income tax return if your income is more than 3 lakh rupees, or 2.5 lakh if you're opting for an old regime. RNOR is basically, this is a concept that's prevalent only in India. It's not there in US. So RNOR is basically, the fundamental loophole, you can say, or a kind of a benefit that you might be able to utilize if you are able to plan things in advance, carefully. That RNOR is a period where you are a resident in India, but not an ordinarily resident. Like you're moving back, and like in first 2 to 3 years you get that tax benefit of being an RNOR. So in the period of an RNOR, your tax treatment is equivalent to an NRI in most of the cases. In certain cases there are some the exceptions, but in most of the cases tax is only applicable on the Indian income. You did not disclose or file your details of foreign income in India. So a lot of advanced decisions can be taken up, like liquidating your 401k, converting your IRA into Roth IRA, or a 401k into Roth 401k. You can make those decisions in this particular period, or withdraw that amount of money from US if you are going to be in India when you are making that transition. So in this period, if you do that withdrawals or you get that income, in India, you would be exempt from paying tax because India is obviously a high income tax jurisdiction. US compared to India is a lower tax jurisdiction. So for certain incomes, it is advisable to use your RNOR period to make that shift, make that change, make that liquidation, and then end up being more tax efficient. And when you're resident, there's nothing you can do. You have to pay the entire amount of tax, globally that you earn. But yes, you can claim double taxation avoidance agreement. India has DTAA with more than 96 countries in the world. So any income that you're earning, I'm primarily that of you are based out of US. So I'm primarily told that, I mean, if you are from US, so India has a double taxation avoidance agreement with US for last 70, 80 years. So using that as a basis of, you can save some tax that you have been paying in US while filing your returns in India and vice versa. Can we move to the next slide, Raj? So I have compiled a couple of questions based on, which is going to help you with this. So what is the best way to take advantage of the RNOR period? As I reiterated earlier, you need to take the best advantage of that RNOR period in terms of, earning income in US when you are in India, but in an RNOR period for that 2 to 3 years, when you return back from US. Uh, you liquidate all your foreign income or foreign earnings, capital gains, uh, 401k, everything, whatever in a way, because your US earning would definitely get stopped or get limited, right? So the best way to take an advantage in that RNOR period to be more tax efficient is liquidating them. But yes, liquidating 401k comes with its own challenge of that 10% withdrawal charges are there, right? So you have to calculate, like it depends on how you are like structuring your transaction, and how you're going to do things in a way that would be benefit you in terms of like timing it out properly. That would require a careful consideration of the facts that is applicable in your case. During RNOR period, can I claim DTAA benefits? Practically, no, because in RNOR, foreign income is not getting taxed in India, so the question of DTAA does not arise. But yes, there can be a cases in which you are in RNOR period, but that income is getting doubly taxed in both India and US. So if that happens, yes, definitely you can claim double DTAA benefits over there. I am a US citizen of US. Can I claim RNOR benefits in India? So it depends actually, like how you want to structure the transaction. So since you are a US citizen, you have to pay tax in US irrespective of anywhere you are in the world. And India does not have a citizenship-based taxation. India has a residential status-based taxation. So if you are a US citizen and you're not letting go of that, I'm assuming. So if you are in India, then you have to pay tax in India as well as in US, and then you have to collect DTAA benefit. Apart from that, there is no other way of doing it, because US charges US taxes its citizen on a basis of their global income, and India also has the similar provision, but only for the residents. So if you're falling in that jurisdiction, you have no choice but to pay tax in both the countries. But yes, you are eligible to claim DTAA benefits to minimize your tax impact in both the countries. How does substantial presence test in US affect my taxes in US and India? So we just went through, how the Indian residential status is determined. Similar structure we have for US, 31 days in the current year, and like total of 183 days in the previous 3 years with the formula one half, one third, and one sixth. The calculation is there, right? So if we calculate that, and if based on that, if you are getting up like a substantial present test, you're getting qualified for that, then you will be considered as a resident in US. And in that even if you don't have a even if you are not a citizen of US, you are supposed to pay taxes in US for the global income that you earn, not just for the US income. And that's how the US IRS works. And similarly in India, let's say if you are in India for 182 days, and or 120 days, if that trigger is there, then you have to pay tax in India and in US, and then you have to go to the DTAA route. There is no workaround for that. should I disclose my Indian income in US returns even if I am an Indian citizen? So as I said, US charges or US has this scheme of taxing its citizens anywhere in the world they are located, right? But India does not have that citizenship based taxation. So it depends on your residential status, whether you are qualified as a resident and resident in US or not. And based on that, then you need to disclose your Indian income. Like if you are a US resident and you have passed that substantial present test in US, then you have to disclose all your returns, all your income that you have in India in the US. And then if there's any TDS that you're required to, if you are suffering in India, you are required to pay tax in India, get that TDS benefit, and get a refund. Or if there's TDS is short, then you have to pay some extra money. But that entire amount, if you're disclosing again in the US, you're eligible to claim DTAA in US also. Does RNOR status impact how I should time my relocation? Definitely. So actually the question should be other way, like based on your relocation, your substantial present test in US and your number of days in India are determined. So let's say if you're planning to shift India, let's say on 1st of April. Now, if you are shifting on 1st of April, then for the financial year 2024, 25, 26, which starts from 1st of April 2025 to 31st of March 2026, you are under the tax bracket because you're crossing that 182 days threshold limit for the financial year 2025-26. But let's say if you time it after, let's say, 1st of December or 1st of January or something like that. So in that case, for the financial year 25-26, you will not be crossing that 182 days time threshold limit, and you will, even if you're returning to India, you will be deferring your RNOR benefits for one more year, and if essentially claiming the non-resident status for the financial year 2025-26. So based on your planning on how you are going to time it, then we calculate whether you are an RNOR or not, or a non-resident or a resident in India. And then if you are a resident, then we go into the discussion whether you are an RNOR or not. So if you, the best case scenario for you would be, claim that residential status as much as non-residential status as much as you can, so that you can defer your RNOR period, as much as you can, and keep getting that benefit of falling Indian rupee, appreciating USD, and the returns and assets that you have in US, so that when you transfer them to India, you get a better return and be more tax efficient. Now, how does DTAA works between US and India? So primarily DTAA works in a very, very simple fashion. You are earning an income. By some virtue, you are supposed to pay income in India and in US on the same income by residential status or citizenship, or if your TDS has been deducted and you need to file that return. So whatever the reason it is, you are supposed to pay that. So now when you are paying that tax, you are supposed to file in India, you have to file form 67. There's some compliances that you need to do, and then you have to file an ITR by 31st of July to claim that DTAA benefit. And for US, most of you are in busy tax season right now handling it. So by 15th of April, you need to file your US tax return along with that DTAA form over there, so that you can claim tax benefits, double tax benefits. So DTAA will come into the picture only if your income is getting taxed in two jurisdictions. So if you are in that non-resident status or a RNOR status, then DTAA would not ideally be applicable to you if there's no tax on the other jurisdiction. But let's say if you're a resident in both of these countries, then DTAA will, come into the picture. Do I have to pay tax in India on my salary earned in US? Yes. Again, even if you're a non-resident of India, any income that is arising in India, you have to pay tax on that in US because you are a US resident, and you have to pay tax in India because that income is arising from your Indian employer, and vice versa. Let's say if you're an Indian resident, but your money is coming from a US company and it is being remitted to your Indian bank account, right? So the same logic applies. You have to pay tax in India as well as in US, because that company is in US, they will deduct some TDS and ask you to pay that tax in US, file your return on behalf of if you're doing on your own. But in India, when you report your global income, you have to do same thing again and again, and you have to file that and you have to adjust that with your DTAA. Can I claim FTC for taxes paid in India while filing my US tax returns? Yes, you have to claim FTC, foreign tax credit, for taxes paid in India while filing. So it's FTC is basically foreign tax credit. So when you pay an extra tax in the jurisdiction that you are not, like in US, if you are an Indian resident, and in India, if you are a US resident, then your home country will become your first country, and the second country is where the TDS is getting deducted. That will become your uh, um, second income country. So any income that you are earning in the second income country, on that, if you are paying any tax, your base country will anyhow cover that tax. And if your base country is covering that tax, then the second income country will definitely, whatever tax you're paying in the second income country, the base country will definitely allow you that kind of benefit, and you can adjust it with your tax liability in the base country. How does mutual fund redemption in India impact my US tax returns? This is a tricky question. It's not as simple as it sounds. So mutual funds in India are covered under the definition called PFIC, uh, passive foreign investment. Uh, I don't remember the full form, but something like that. So PFICs are taxed in US as per their slab rates. They are not considered as a safe investments in US. So, in certain cases, they go up to 37% of tax as per the IRS regulation. So it's not advisable to invest in mutual funds in India, and if you're redeeming it, it's not advisable to do it while you are a resident or an RNOR period. You should do it only when you are in the residential, fully resident in India. Then only you should do that, so that you can minimize your tax returns, US tax cost on that. How is capital gains tax applied when I sell property or stocks in India as an NRI? So capital gains tax are applied, so it's very simple. It's like the way Indians deal with it. There's a capital gain calculation, indexation, which is removed right now, but earlier it was there. All of that is happening in if it is subject to STT, and if it is in Indian stocks, you get that long-term capital gain, short-term capital gain, period of holding, and all those things. So it's very similar whether it is for a resident or a non-resident. It's very similar. The only thing is the TDS provisions get changed. For residents, the TDS provisions are like quite less, but for non-resident, the TDS provisions, allows for a 22% TDS on the payments that is being made. Let's say if you sell a property worth, let's say, 1 crore rupees. So the buyer will not deduct 1% TDS from your property for the money that he is paying to you. He will deduct 22% TDS for the money that he is paying to you. And you need to file your income tax return, disclose or calculate and disclose all of your profits and capital gains and all of those things over there. And then you have to pay tax over there in India as applicable. And if, let's say, there is a surplus in India, then you have to claim an income tax refund from the Indian Income Tax Department. Are dividends from Indian stock taxable in US? Yes, it is taxable because uh, before 2018, before 2020, any dividend that you were receiving was tax-free under Section 1034 of Indian Income Tax. But that section has been now abolished. That exemption has been now abolished in India. So any dividend that you're receiving in the income tax, regardless of your residential status in India, you're liable to pay tax on that. What are the tax implications of receiving gifts in India from family and friends? So if you're an Indian resident, any gifts that you're receiving from your family, like there's a definition of relative that has been prescribed in the income tax department. If you are covered, like basically you can think of like your and any um, any descendants of your grandfather and grandmother, and from your paternal side and from your maternal side, their family is covered, but not the brother of or sister of your grandfather and grandmother from either side. They are not covered under the definition of relative. So any money that you are receiving or any gift that you are receiving in India, if you are a resident, then it is tax free. But if you are a non-resident, then under the US laws, it is taxable and you would end up paying tax in US. So it is again a very subjective thing, depending on whether that relative is there, some other factors are there. Section 56 of Indian income taxes also gets applicable. Depending on that, we will have to decide whether you are, whether we can claim that tax exemptions for those gifts that you're receiving in India from family or not. But for friends, certainly those gifts in India are taxable. This is clear, except in the case of, certain cases like marriage, or the cash amount is less than 50,000. There are certain exemptions, so we can, like if we get on one-to-one conversation, we can probably discuss more on this and work out a solution for you on this. Now, this is a very, very burning question of investments and property rental. Should I move my investments out of the US before or after returning? So now, it's basically the same question being asked again and again in a different format, I think. So, so let's say if you have an investment in US, so the nature of that investment, whether it is a 401k or a Roth 401k, or IRA, or if it is a asset, or a rental, a building or or a property which is giving you rental income, it depends on all of those things. Should you sell them or not is purely a question of case to case specific. Like there's no uniform answer, like do this and like this is final. So it all depends on whether you need to do that or not. But the best period of that selling, and if you want to sell and come back to India, is capture that RNOR and the NR period before you come to India, or if like RNOR period is available to you once you come back to India, it is available to you for that period of 2 to 3 years once you're back to India. So during that period, if you're able to sell all of that and get it remitted to India, that's the best way of getting it out, because you don't end up paying tax on that in India. But yes, in US, the tax would still be applicable as per the capital gains and whatever that income is. There could be an estate tax also, if you do that. Is income from rental properties in India taxable in US? Yes. So the rental properties are fully taxable in US as well as in India, without any exemption. In both the countries, there is no exemption on this. What are the TDS rules for NRIs for selling a property in India? So for NRIs, if you sell a property in India, as I said about TDS, the TDS rate says 22% plus 10% on 20% plus 10% on that 20%, that comes to 22%. And then there's a 4% education cess, which boils down to 22.8%. So whenever you're selling a property, you being an NRI, you're selling a property in India, and the buyer is buying from you, he has to deduct 22.8% TDS and then deposit it against your PAN number. And when you file your income tax return, which you are supposed to file, then you have to claim that tax benefit. If your tax, there is no tax liability on your sale of property, then you can claim that excess money in your Indian bank account. You can't get it in your foreign bank account. It has to be an Indian bank account. Do I need to report Indian income even if I don't owe any tax in US? Yes. So the Indian income needs to be disclosed in US if it is affecting your basic exemption, which is, I think, is around some $13,000 or something. If your total income in US is more than that $13,000, any income, global income I'm talking about, if your global income is more than $13,000, you have to report your Indian income in US, and then you have to pay tax on that. And if you have paid any tax on that Indian income, you have to file for foreign tax credit in US and claim that tax benefit. What forms do I need to file in the US if I have an income from India? So ideally, there's something called 1040 that you need to file in US if you have an income in India, and and there are some other forms. We can get into these details, but we are running a bit short of time, so I'm going to go more, and there are two more slides. How do I get refund of excess TDS deducted in India? Simply you file your income tax return, substantiate, show the disclosure of how your capital gains or your dividend income, your other sources, and your rental income and everything is covered. And based on that, whatever tax you are paying, if there's anything excess TDS that is there as per the calculation, it will be remitted back to your Indian bank account, even if it is not linked with your Aadhaar. Yeah, so this is the sheet which kind of which will help you, understand. So if let's say you have your US capital gains in stock, ETFs, mutual funds. So in US, there's a 0 to 20% LTCG. In India, in the RNOR period, there is no tax in India. But if you are in residential normal ROR period, there's a 20% LTCG tax in India. For DTAA benefit, yes. If you're paying tax in US, India will allow you that DTAA tax benefit and vice versa. But we are talking about only US capital gain. So the DTAA benefit will extend to only India. Dividend from US stock, yes. So any US stock dividend that you are receiving, you would be having 1040 N form that you would be filing in US. Take a copy of that. Generally, it's a 25% US TDS. That 25% rate is a DTAA rate that has been prescribed. And in the ROR period, you do not pay tax in India, but in the ROR period, you pay that tax in India as well as in US. And that 25% US TDS that has been deducted in in the US, that will be eligible as an FTC in India against a tax that is calculated on the dividend income in India. US rental income. So depending on how it is structured, some 10 to 37% tax after deductions, whatever it is. Same logic. So you pay that tax in US at that in the form of either TDS or in the form of advance tax or in the form of filing a proper income and paying self-assessment tax. But when you file it in India, you disclose the same income again, and you file that tax over here, and you pay that tax amount, and any TDS, any tax that you have paid in US, you can claim that as a FTC benefit. Yes. Just give me a moment, please. Yeah. So basically, in order to claim DTAA benefits, you can claim FTC under Form 67. In the RNOR period, try to sell US stocks to avoid India's 20% LTCG tax. Now, there could be a possibility that you can say that there's a 12.5% tax, but I guess that 12.5% tax is there, but that is only on the Indian stocks, not on the US stocks. So the concept is very simple, that 12.5% tax comes under Section 1038, which states about, recognized stock exchange. Recognized stock exchange are the Indian stock exchange that is recognized by the income tax department. Unfortunately, all the global stock exchange, however authentic they may be, it's not recognized under the income tax department. So you do not get that 12.5% tax benefit that you have in India for the US stocks or for any stocks in the world, whether it is listed or not. Keep rental income in the US and repatriate only when it's needed. Yes, that's the ideal way of doing it. Yes. Next slide, please. Now we come to the most important topic, I think. So your 401k, IRA, Roth IRA, pension plans, etc., are these taxable in India? So as per my understanding of 401k, you make 401k as a deduction. You claim contribution to 401k as a deduction when you file your current year's IRS return. And after 60, whatever amount you withdraw, you end up paying tax on that. But there's a general understanding is after 60, if you're earning, if you are not having any source of income, you can claim that basic exemption and then you can pay tax on that. And then there's again a 10% penalty on withdrawing that amount from your IRA from 401k before you're 60. So the general consensus over here is when you're moving to India, you should not sell, or if you are planning to sell, use that NR period or that RNOR period to liquidate all your 401k and IRA if you do not have a substantial Indian income. If you do, I would suggest wait for a period where you would not have much Indian income or a US income apart from that 401k. Wait for that low tax period in your career. And at that point of time, liquidate all that 401k and IRA so that you can get appreciated dollar value also. And you can get a better return on your investments also. And you can escape some tax also. But if you do that, uh, you end up paying tax in withdrawn money in 401k in US, and the tax is there on India also. So then you have to go through the DTAA and that FTC, foreign tax credit route, whenever you are withdrawing money from 401k or IRA. Roth IRA is a bit different because contribution to Roth IRA happens on from your after tax money. So it's a bit nuanced over here in terms of how you're going to structure it is. For Roth IRA, if you are making contribution from your after tax money, there's no tax exemption, there's no tax benefit in US. There's no tax impact on this in US, but in India, every year that appreciation that money that has in Roth IRA, it is a litigatable topic, but yes, any extra money that you have in Roth IRA, that money will be charged in Indian income. They are required to be reported to Indian tax authorities. But an argument can be made of not disclosing, and we can compile and add all of that tax payments, when we are disclosing entire amount of money when we liquidate the Roth IRA. Same is applicable for pension plans. If it's an after-tax money that you are investing in US, then there's no tax impact in India for investment. But for withdrawal, whenever you withdraw from anyone, 401k, IRA, Roth IRA, pension plans, anyone, there's a tax implication in India. You end up paying tax in India. Should I disclose my 401k and IRA investments while filing my Indian income tax returns? Yes. So there's a Schedule FA, foreign assets and liabilities, that you are required to disclose in the Indian income tax return. It is applicable on ITR 2, 3, 4, and all of these returns, ITR 2 and 3, sorry, not 4. So 1 and 4, it's not applicable for non-residents and RNOR people. So ITR 2 and 3, you have to file and you have to disclose under section FA, foreign assets and liabilities. You have to disclose your entire detail of 401k along with peak period, currency adjustments, currency conversions, everything, and closing balance and everything. And if your income is more than 50 lakh, you also have to submit your global assets and liabilities, which you are required to do, on which you are required to include all of these investments that you have made in multiple countries, including US or any other country that you have done. Even if you have a $50 bank account in, let's say, Canada or any other country in the world, if your income in India is crossing 50 lakh, you are required to disclose that via that Schedule AL that is there in the ITR. Can I transfer my social security benefits to India? Yes, it is covered as per Article 20 of India US tax treaty. Transfer of social security benefit is covered in that, but there are no tax benefits available on that. So India does not recognize social security benefits. So while you can transfer your social security benefits to India under the treaty, but there are no tax benefits available on that. PF and PPF in India is basically the same as 401k and Roth IRA in US. So whenever you get any money in PF and PPF redemption in, so that money becomes tax-free in India, but unfortunately they are taxed in US because there is no exemption available in them. So any money that you withdraw from your PF or PPF, it's fully taxable in India, in US. Next slide, please. So this is again a summary of what we have just discussed. So 401k is in the US, it is taxed as an ordinary income. In India, it is not taxable if you are in the RNOR period, but if in the ROR period, because your global income is taxable, it is taxed as an income. Traditional IRA. So IRA is of two types. So traditional IRA, now that is taxed as an ordinary income if it is withdrawn from US. In the RNOR period in India, it is not taxed, but in the ROR period, it is taxed. Roth IRA is basically tax-free in US because it is paid from a after-tax paid money. But in India, even if you're in the RNOR period, it is taxed in India whenever you make a withdrawal from that, whether you are in RNOR or an ROR. So when the idea is if you have a Roth IRA, if you're a non-resident, withdraw it because it's tax-free in US. If you are in the RNOR period or if you are in the proper Indian resident, do not withdraw it. So ideally, the best way would be, liquidate that before you come to India. That's the best case scenario in that. For the US stock, in US you have 15 to 20% capital gains. In India, it is not taxable in the RNOR period, but in the ROR period, it is taxable. Again, same logic applies. 12.5% is not applicable to you because it's not a recognized stock exchange as per the Indian Income Tax Department. But so that's why you can't claim 12.5%. 12.5% is applicable or available only for Indian stocks and mutual funds. So it will be considered as a normal stock, normal long-term capital stock, that is 20% slab rate will be applicable to you. So the best case scenario would be, sell it during RNOR period and when you're a non-resident. Next slide, please. So there might be more questions. I'm sure there would be plenty of more questions than this. I've
Yeah.
just just
Yeah, so I'll just come in over here. I think, Ankit, take a sip of water. I think 30 back-to-back questions were addressed. So, and I know I was just observing the chat. There are tons of more questions which have sort of off-rooted from the topics we were covering. So I'll give you a moment, Ankit, to look at the chat. Some of the questions we will be covering maybe in 5 to 10 minutes, and so some of the answers, Shruti, we'll need your help also. We are running slightly late on the schedule, but let me quickly cover up 2, 3 slides, which are also important in addition to the topics we are covering today. And then quickly we'll open the floor for the questions, and we'll address the questions in the chat. So as you can see on the screen, this is not it. There might be more questions, and there are. For example, you might be having questions related to your estate planning, how to ensure your estate in India and abroad. How does the nominee and beneficiary thing works in India, or maybe what's the right time to move back? That requires fair bit of calculation. I could see this third question in the chat also. How could I time my RNOR? What is the right time to move back? And also possibly some of the pointed answers around what are the good banks in India, what are the good insurance products and things like that. As you can understand, these things would require personalized conversations. Similar to the fifth and the sixth question, should I invest in India, continue to be in the US market? We would need to understand your goals. We hence are the core of our platform. Also, start the journey of any client starts with goal-based financial planning, and then the tax and the banking and other things also fall into the system. So these are some of the questions which are on the screen, which we're not going to cover today. I'm sorry for that, but we do have answers to these, and you can connect with us, and we will help you with the answers. And there could be more questions like these, because the shorter answer to all these questions is it depends, and it depends on a lot of other things which I told you right now, about your goals, about your timing of coming back, the years you have spent, your family, your sort of circumstances, your kids being US citizen, not being US citizen, and future goals in life. So that's the two-word answer at this point of time. uh, And I'm guessing, while I could sense a lot of excitement. People are consistently putting their questions on the chat. We'll pick them up. We'll pick them up. So definitely, people are not confused, and they're thinking what next. So the only piece of advice today is that seek advice only from qualified financial advisors. That's being one. You are meeting two of our teammates today. There are more like these. So we are one-stop shop for everything related to personal finance advisory. This is the sort of promise we make to anybody coming in. I know it might feel like a sales pitch sort of coming in, but I want all of you to understand the platform for a minute, and then we'll again go back to the question. So this is the only promise we make. We are a fixed fee platform, getting you access to right financial advice only from qualified financial advisors. These are some of the key differentiators on what we do. When you visit our website, when you book a call with us, you'll get to see these also happening. There's no capping on number of calls you take with any advisor, or how does the fee work out, or do we give any stock tips or not. No, we are not into any shady things. We don't have any backdoor earning sort of a channel. I'll sort of cover these when you sort of visit us. Book your call, take out your time, pick a slot, and you can schedule a slot, and then I'll explain you how the journey works out. It's typically a 8 to 10 call journey, covering all aspects of your finances. So we related to investment advisory, cross-border taxation, banking and compliance, insurance advisory, estate planning, and credit card advisory. These are six verticals bundled into one membership program. That's what we offer today to any NRI who comes to Total. So I think I'll take a pause over here. I'll let Avan sort of take this ahead from here. Avan, which question? How do you suggest we should
Sure.
take?
I think so. What I'll do is, I think there are so many questions. What I'll do is, just based on my experience from the group and some of the questions here, maybe I'll just summarize a few and ask, so that we have time for a lot of them. I think the first one, and I think the probably the most important, or most commonly asked question is in RNOR, because your US, because you're a non-resident in the US and RNOR in India. Your capital gains in the US are not taxable, and India doesn't care about capital gains in the US. So, is it true that you are able to avoid tax in the US as well as India in RNOR if you were to sort of sell your stock or maybe reset your cost basis?
That's actually incorrect. In the RNOR period, if you're selling a stock in US or
Mhm.
if you're having a capital gains in US, US will charge you some capital gains on that, even if you are in RNOR, because that asset is essentially established, or I'm saying present in US. So as per the India US DTAA, the capital gains are charged in the contracting state, where that asset is located. So in this case, if the asset is located in US, US will charge, but the India will not charge. So there could be a possibility that the US tax returns might not be, properly disclosed or filed, or, there's a misconception around that. But that return, that disclosure, the capital gains, even if it is a loss, it is allowed to, be carried forward if it is filed on time and
So,
properly.
clarifying, even if you're a non-resident of the US, you are a non-resident of the US because you don't pass the substantial presence test.
Yes. So even if you're a non-resident of the US, that income is kind of essentially accruing or arising in US, right?
Okay.
So in that case, even if you're a non-resident of US, that income is generated in US and you have to essentially pay in US.
Okay, because I think according to the rules, non-residents don't really have capital gains in the US. At least that's what I had read about. But
There is actually. So there are certain forms that is required. So if your CPA is there, a proper person who is helping you with it, they'll help you, file that returns properly.
okay,
There are certain other forms in which that is it. It's not in the ordinary scenario, but it is there. It is required to be filed over there.
okay. Next was, is it possible for RNOR to extend beyond 2 years, maybe for 3 years?
Yes, yes. In certain cases, you can extend RNOR from the 2 years or 3 years. As I was talking about that example, no, if you are moving to India, let's say on 1st of April, then you'll definitely have 2 years. But let's say if you are moving on like 1st of January or something, you will. It depends on each and every scenario, your number of days, your prior visits in India, the 729 days clause, two residential status. So we can handle that calculation. Based on that, there is a possibility that you can make it under 3 years,
Got it.
but not more than 3 years.
Okay. And what about estate tax in the US? I think some of us, even I have that question actually. We have assets in the US, and everyone's worried that there is like a very high estate tax in the US for non-residents, and the limit is very low. I think it's around $60,000.
60,
So,
60, anything beyond 60,000, you end up paying 40% tax as an estate tax.
is there any workaround?
There are workaround for that,
Okay.
but that requires, that asset to be listed over there. It depends on multiple factors which can be designed and executed in a very structured period. Create a transition using, certain tools, certain trust that we can create, certain like sole trader, or like there are a lot of options that are there, like legal tools are there. Using that, we can create that, we can transfer that, we can gift it, a lot of these things we can do depending on the goal that we want to keep in. And then we can find a ways to save it. But it will definitely, whatever the solutions will propose, based on that, the cash flow is going to be determined. So it might
Got it.
not always be the cash flow friendly,
Got
the
it.
solution.
And I think you touched upon taxes in India while working for a US company in India. Maybe like what usually happens is when people come back to India, they sort of continue working for their US based company for a short amount of time. Sometimes that US company is not does not have a presence in India, right? So they don't really have a presence. They're only based in the US. So how does taxation work? I think asked on the chat as well. When your salary is being credited to the US account, but you are working from India, and I guess you are probably RNOR at that point of time, NRI or RNOR. So do you have to pay taxes on the on that salary in India as well?
So actually, it kind of depends on. So like, allow me to speak a bit freely. So what happens is, um, in when you're in India, practically speaking, so most of the companies that have salary paying, that they're paying salary to their Indian counterparts, they don't pay their salary to directly to the Indian employees' bank account. They
Mhm.
generally either have a subsidiary company in India established, or there are private players providing like team lease, and a lot of companies are there, they are providing remote.com and all, they are providing those solutions through which you can remit that salary, and that local team kind of issues you form 16, and then you can take care of it. But yes, theoretically speaking, if that money is coming from a US based bank account in the Indian bank account from a company which is located in US, right? So essentially, that's a bit of a litigation. I mean, that requires a bit of more closer look to understand what's exactly happening. And then based on that, we'll be able to decide whether we can, like, is if there is a US taxation involved in that or not. Indian
Mhm.
taxation, definitely it is there, because the income is received in India, and if you're a resident, then definitely
So
globally.
income is actually in directly deposited to your US bank account in that case as well.
Yes, so
Okay.
yes.
Okay. I think someone asked a very fundamental question, uh, which is something I want to ask you as well. If there is DTA and there is no scope of paying tax in both countries, why is it such a big deal to do everything in RNOR? Like anyway, you're going to pay tax in only one country. So what's the actual advantage of RNOR then? If you're anyway at any point of time in your life going to pay taxes only in one country.
Yes, so in certain point of time, let's say if you are in US for, let's say, 4 years, right? And you want to move back to India for good, and you want, so there are a lot of problems, regulatory framework problems, prohibitions that's there in India, which Shruti was able to touch upon, was that being an Indian, there are certain restrictions on owning assets in US, owning or liquidating on, and there are certain regulatory requirement or a framework that mandates us to sell certain assets, because we are not allowed to hold them, or if we are allowed to hold them in a different way, or there's a compliance cost involved, if you are maintaining that in US. So sometimes what happens is, in order to avoid that compliance cost of that FBAR reporting, for example, if you have assets more than
Yeah.
10K in US, you have to report that FBAR filing, right?
Yeah.
More than 10K dollars. So those require a lot of compliances regularly, even if you are in India, whether you are in RN or a resident. So sometimes that becomes very cumbersome, like you have left your US, right? And there's a lot of compliance that is going to be involved, and it's recurring. Every year you have to do that. So sometimes it's better to, sell everything, come back to India during that non-resident or an RNOR period, paid tax, whatever is applicable in US. India doesn't care about that tax in that particular period. So it works better in that particular period. But let's
Got it.
say if you have plans to go back, or if you have some other goal in your mind, right? Then it will again depend on, how we are going to deal with it.
Got it. So your rationale is mostly around compliance rather than like profiting or
Compliance
taxation.
is one of the reasons, that is the most common reason, I would believe. But then there are some other, goals. Like recently we had a client at Turtle where, that person, he's in India, but he wanted his children, he wanted to, go back after a decade back to US, and, wanted to create a trust for his children over there, because the children is also US citizens, right?
Yeah.
So in that case, what would happen? So again, the answer to these questions are like, even if like questions might seem very fundamental, the answers depends on, facts and circumstances on each case.
Right. See if there are other questions. In the meantime, I mean, I guess if anyone wants to unmute and ask,
We
that's also
can touch
fine.
upon a bit on the compliance aspect on this
Yeah.
particular question.
So I think this is for Shruti. Can we deposit funds into RFC accounts directly from a foreign bank
Yes.
while converting USD to RNR, INR from RFC account? Do bank charge any fees?
Okay, so firstly, for the deposits and all, there is no exclusive fees which is being charged. Either you make a normal fixed deposit here, or an FCNR, or an RFC. And also in the RFC account is maintained in the foreign currency account itself. So there is no forex transaction charges or the banking charges also which is involved in this. You can directly transfer the money from your account and open an RFC account with any of the scheduled bank in India.
You mentioned if we hold cash in foreign bank account and rupee depreciates, we need to pay tax as it's considered income. Did I understand that right? I don't think so, right? That's not income, right?
No, that's not an income.
Yeah,
That's a saving account which you have accumulated
yeah,
in another country.
yeah. Will India charge tax on income already charged in USA? I think that we already covered. They won't charge anything. What is the
Can I?
best? Yeah, yeah. Go ahead.
So you just said that estate tax, if you have investment more than 60,000, we have to pay estate tax, right? So like, let's say if I am moving back now, and after 2 3 years, my son wants to come to higher studies. Can I keep no, more than 60,000 in my checking account, because I'll not be getting any interest or something? So just want to pay the fee in dollars. So can I keep that much amount in my checking account while in India?
Uh, I would like to take this.
Shruti, you can take this, yeah.
Yeah, yes, you can do that. Actually, many people prefer to do that, but because what happens is the schooling and all the kids are going on there and all. It is always good if you are paying in the dollars, and you get the substantial benefit also on that because it is your accumulated funds. You can definitely go for it. There is no restriction on this as such.
Okay, thank you.
Hello. Hello.
Hello.
Yeah, hi. Yeah, first of all, yeah, it's very informative session, and you touch up regarding a little bit about the turtle and all the services, but you didn't mention any kind of a annual charges or fee structure over there. So, what are the?
Yeah, I'll take that up, Kunal. Hi. So Kunal, we charge a fixed fee of 50,000 rupees annually from a client that gives you unlimited access to all the advisors today. It's a fixed fee model, irrespective of the size of assets or uh, uh, the sort of corpus you have at this point of time.
Hello.
Okay.
Yeah.
Hi. Yeah.
Hi, my name is Naga. First of all, thank you so much for bringing all of us together and answering patiently all these questions. Appreciate that so much. I know it's India evening time, and I assume you guys are in India as well. So my question is regarding the long-term capital gains tax in India on the sale of US tax, sorry, on the sale of US stocks. For example, let's say I move to India down the line 3 years, I become the resident of India and I have stocks in the US and I sell them, and they're long term holdings. And you said it's 20% long term capital gains tax in India for the sale of US stocks, right? But I read online and something has changed very recently, maybe within the past 1 year or so, and even for US stocks, the long term capital gains is 12.5%. Am I reading it incorrectly? Because even Zerodha, which is updated recently in February or January, that article even says it's 12.5%. Can you clarify? In the table, it's mentioned 20%, so I'm just curious.
Yeah, there's a reason all of us are smiling. Ankit, you want to go ahead? Yeah.
Yeah, so basically, if you read the text of the section that in the Income Tax Act, which is again changing next year, from 1st April 2026, the new income tax act is coming in India. So we are still, reviewing that. But under the Fast Income Tax Act, the definition of a capital asset is basically for the purpose of claiming exemption under Section 1038 is for the 12.5% eligibility is recognized stock exchange. So recognized stock exchange, as per the schedule that has been again listed in the Indian Income Tax Act, is the Bombay Stock Exchange, the National Stock Exchange, and few other local stock exchange on which the treasury bonds and commodities and all those things are traded. So apart from that, there's no, like, forget US, there's no other country in the world that is, doing this kind of thing. So the keyword over here, that's what I'm saying. So if you look at this, primarily what you're saying is right, but if you go into the detail and if you fill up test basis on, if you fill up income tax form and you try to validate it over there, it will tell you, 20%.
Is this something that is like open to interpretation, or it's generally accepted that's all it's 20%? Or maybe if I ask someone else, will they say it's 12.5, or it's actually very well accepted?
Actually had a case also with the income tax department, a tussle on that, few years back in 2021 or 22, around the COVID time. There was a client who insisted on, paying tax on the basis of 12.5%. See, there's something called, securities transaction tax, which is applicable only on the Indian stock exchanges. Globally, there is nowhere, that securities transaction tax is being charged. Now, the wordings of that section 1038, where this exemption is coming, it specifically talks about securities transaction tax. And that's how, tax officers are interpreting it. And that's how, the tax softwares in India are also designed, which is released on the basis of schema released by the income tax department every year. So it is not 12.5% on the US stock assets, even if if it is listed in the US stock exchange, because the matter of the fact is they are not listed in the Indian stock exchange and they're not paying STT of 0.001% that is there, right? So because of that failing, because of that incompleteness, it's actually 20%. It's not 12.5%. It's something that, if it gets into scrutiny, you will definitely lose out on this.
Got it. But is that long-term capital gain adjustable and with
Yes,
long-term
yes,
losses,
yes,
both in the same exchange? It's
yes,
all done.
yes.
Okay, any other questions?
I have a question on estate tax. So this is something, say for example, if one move to India, maybe after 5 years, if they plan to take the money from 401k, is the estate tax the only tax will be applicable on the 401k withdrawal plus penalty, or is it on top of standard taxation? Like say for example, if I'm withdrawing 100k, so which will go with the standard US tax slab plus 40%? Is it how it works, or why the tax state is something different than the regular taxation?
Estate tax is in addition to your regular taxation that you pay to the IRS and also that you pay to your local income tax department. Like, for example, if you are in Texas, you don't have any local state tax, right? But if you are in California, you end up paying a high amount of local state tax. So estate tax it is in addition to, the local tax that you have to pay over there.
Okay, so if we withdraw like 100 or 200k, then it will be like totally 40 plus another 20, so around 60% will go off. That is how you're interpreting, right?
There are ways to design this, in a better way, more tax efficient way. But if you ask me on a theoretical basis, the answer is yes.
Okay, okay, thank you.
I have one question. Can you hear me?
Yes, go ahead, Deep.
Yeah, so I have this question related to Roth IRA. So when you say India taxes Roth IRA, are you talking about dividends and realized capital gains, or are you talking about principal, dividends, and even unrealized capital gains?
So when we talk about Roth IRA, Roth essentially means all the after-tax money that you are putting in the US. So Roth IRA, Roth 401k, I think there are a few designated instruments that you have in US which are used purely for the purpose of saving some tax. Now, all the appreciation that happens on that Roth related investments, that is, taxed in India if you are in the residential status, not in the RNOR or a non-resident period. But in the US, they are not taxed till the time you turn 60. And on also, when you withdraw your money after your, 60, subject to if you're crossing that 73 limit. So if you're withdrawing after 60, there's a restricted tax on that. Not the entire amount of withdrawal that you do is tax, only on the appreciation amount that you have to pay tax, when you're withdrawing that amount. But in India,
But
entire appreciation, irrespective of whether it is realized or not, whether you have withdrawn or not, you have to report in India on the entire amount of that appreciation, and you have to report it in India as a tax, as an
oh,
income.
yeah, means even if I don't sell it in Roth IRA,
So, yeah, so that's the problem with Roth.
okay, so they charge the appreciation. Okay.
Charge on the appreciation of the Roth over and above the
Okay.
50.
Question to the previous related to the
Yeah, I have another question. So, I have an mutual fund investment and stocks before coming to US, and I'm continue doing it in the same domestic status. So, how that implies? Do I have to take a call on either closing it or converting to an NRI status, demat and mutual fund, or what I have to do there?
Can you share me a few more details? Like, currently you are a US resident, correct?
Yeah, I'm an US resident, but I have stocks and mutual fund which I when I was in India, I had that all the accounts. So and the investment, I continue doing it in the same account, meaning it is domestic or individual resident or whatever the standard is. Who stays in India, it is the accounts are in the same format, but I'm continuing investing in those accounts without changing the status on it. But I'm in US more than 5 years now. So what I have to do that?
So I'm assuming you're referring to your investment mutual funds and stocks that you're continuing to do in India via SIPs and other things, right?
Correct.
So what we can do is see, this is a very, very specific question. What we can do is we can schedule a one-on-one call on this and then give you a more detailed on this. But the generic answer is again, like once you do this, you ideally end up paying a lot of tax in US at the time of redemption, which can go up to 30% depending on your income in US. So there's a structured way of doing this would be, um, changing some certain documents in India from a compliance perspective, restructuring it, shifting it. It will require a lot of effort. I mean, I don't have a straightforward answer for that. I'm sorry about that. I mean,
Okay, that's
have to
okay.
sit together.
But keeping that account active, is it still legal or is it considered to be not a right practice?
It is not the question of legality. It is the question of actually being in compliant with the reporting that you were supposed to do when that event of that you became non-resident. You didn't update to them. So it's basically the failure of that non-reporting, which can be fixed with some fines and most of the case in certain penalties, I believe. Shruti can cover more on that, I believe.
All right, thank you. Thank you so much.
Yeah, so in such case, basically, holding a demat account and the PIS account is very different for an Indian resident and for an NRI here. So for an Indian resident, only a demat and a trading account is necessary. But for NRIs, PIS account comes into the picture, and there are regulations in which you cannot hold multiple PIS accounts and all. So under this scenario, firstly, yes, as Ankit said, there is a reporting issue. You have not reported. So now what is happening is, suppose you are redeeming or selling your mutual funds or the stocks, which are, so you are incurring the capital gain. So firstly, you are an NRE, and the applicable TDS will not get debited from that. So it is all reported as a resident capital gain. And when you are filing the taxes and all, if gets noted, it will be a legal issue, compliance issue. So I think it is better to comply with it, because you are in US for 3 years now. For once it is all like non-compliant thing always cost a value, either it is here or in US. You can take out a little bit of time, contact your broker, and get it all converted. You can hold all the stocks and the mutual fund what you are holding in India, just convert it to NRO, and you can, for current trading, when you are an NRE and you want to trade, you can open another NRI PIS account and continue trading and buying the mutual fund and the stocks through that.
Okay. Or can it be transferred during the vacation? Can it be transferred to the parent as a gift or
Yes, yes,
something?
yes, yes.
That,
It is all with the two pink slip and the white slip. You must have be aware of. You can actually transfer it to your relatives who are settled in India. You can open an account on your mother's name, father's name, and all, and you can transfer all the stocks. If you are not planning to sell it for now and holding it, you can transfer to any of your relatives.
okay. All right. Okay, that's wonderful. Thank you. Thank you so much.
Shrikant had a question. I think his
But
voice
mutual
got.
fund can be transferred.
Sorry.
This is Srikanth. I
Yeah,
just have a
Shrikant, go ahead.
question.
I think Vamsi, you can go after that. After him. Yeah.
So basically, my question is the 60K limit that we are talking about, right? Like if kids are US citizens, but we primarily want to go back to India, right? If we give those assets to them in India, is there any concern like that? Are these estate taxes or those scheme? Like I don't have any asset in India, but US, but all my assets are transferred to India and I give them those assets to India as they continue, right? But they're US citizens. Are these estate tax and all those things still applicable?
So if you don't have any US assets, estate tax are ideally taxable on US assets. And if you're not having any US assets, so in the future, any income that any assets that you transfer from your yourself to your children, it will be the assets of India. So the taxation is over here, estate tax will not be applicable on the assets of India, even if
Okay.
your son are like US citizen.
Can you repeat the answer again? I tried to capture it. Even I have a similar question. What was the answer? Can you repeat again?
So if
So
you're
like,
if you're
keeping the money and then later transfer it to the kid.
So let's say if your assets are all in India, right, not in US, so estate tax does not apply even if you are transferring those assets to your children who are who are US citizen.
I think the previous person's question is more like the 401k, I believe. Is it right?
In general, the question is like I
Okay.
don't hold my assets till fag. I slowly transfer them back to India and transfer those to my kids back in India rather than US, just to avoid this estate tax that we are talking, right? Whether it is 401k, whether whatever gains, right? In my lifetime itself, I transfer it to the kids in India, not in US.
So basically, you're saying you're transferring all of your US assets directly first to yourself and then to your children,
Correct.
or directly to your
Correct.
children.
To me and then to my children later. Yeah.
So then it's a two-step transfer, right? First, you're transferring
Correct.
to yourself. That's basically, transferring one thing. Now all of your
Okay.
assets are in India, and then you're gifting all of that assets from your
Correct.
assets in India to your children. So it's an Indian
Correct.
thing. No? There's no estate tax involved over here.
Correct.
Any other questions? I think we can go for 10 more minutes, I think, and then we can call it a day.
One last question I asked it, even in the slides that you showed, Ankit, right? Like the same question that Avan was asking, right? We have to pay tax irrespective in one place, but there is some breach catch and startling that India taxes again, right? So if you didn't follow that, either you pay in US or you pay in India, irrespective. The numbers might be slightly different and those kind of things, but there is no avoidance at all, right? You pay somewhere because you said it's not applicable, it's applicable. So like it's not
So
easy to.
see, so I can go in on and on, talking more about this, but the fact or the real truth is basically, it depends. Like, we can sit down with you, check if if that's a possibility, guide you, how to do that. A thing where we are, open to that possibility where we end up paying tax neither in US or in India, right? But even if we do that, there's always a lingering thing that, we are not paying tax in US or in India. So is it an undisclosed income? So there's a section 68 in Indian Income Tax Act that talks about undisclosed income. It is a very litigatable topic. So the best way forward would be, it's better to pay tax in one country which is a cheaper tax rate, so that you can avoid these litigatable questions in the future and be safe with it. that it's not an undisclosed income, it's a disclosed income. And there's not a, if let's say there's like, for example, in the case of crypto, there's a lot of uncertainty that was there, back 2 or 3 years back. So a lot of people who have not yet disclosed their crypto related holdings, now it is being deemed, if there's an income tax rate, and if it is found that you have a crypto and you have not disclosed it in your income tax returns, right? So it is considered as an undisclosed income, and they charge 60% tax on that, 200% penalty on that, anti-money laundering and a lot of things, that gets triggered. So the best, my point is, it's is like when we sit with you and we'll, one-on-one basis, we try to evaluate what is that scenario, how are we going to deal with it, what kind of risk that it carries with it, what is the kind of your risk taking appetite or a capability, and based on that, then we tell you, what is the way of moving forward and how we should handle this particular scenario.
Ankit, on the question of crypto, now that you mentioned that, is it does it make sense to actually transfer the crypto from a US exchange to an Indian exchange, and so that now you're part of the Indian compliance purview rather than the US purview?
So your crypto is held at which data center, like which company, like where are you holding all your
Coinbase.
Coinbase
Coinbase.
closed its operations in India? I'm sure you're aware of that, right?
Yes.
So all of your crypto which is lying in US data center is, if like it's in US data center, I believe, right?
Yes.
So if anytime you sell that in US, you can't sell that in India because you'll not get any money in India. So any money that you'll get in dollars and you'll get in US, right? The moment that money is brought in India, depending on your residential status, it will be categorized in India as a virtual digital asset under Section 115 BBE, or in US, if you're doing, then the regular long-term capital gain, that aspect that will apply on the crypto.
So if I understand, you're saying it's better to transfer
In
the
the US.
crypto from a
Yes, it's
to a
better.
Sorry, say that again.
Do not transfer it to India. Whenever you need that money, you liquidate that crypto in US, collect the money in the US bank account, and then remit that money in the US bank from your US bank account to Indian bank account. That's the better way
But
of doing it.
then, but when I'm filing taxes in India, I should be declaring the crypto assets.
That
Correct?
again, filing taxes in India is a question of your residential status. So I'm saying right now you're a non-resident. Right now is the best time to do it. If you are moving to India and then you're doing it, then maybe you can use that RNOR period to avoid it. But otherwise, if you are a resident in India, then you're going to end up paying tax in both the countries.
Okay.
Awan, we should we call it a day, or should we take it offline?
Yeah, I think we've answered a lot of questions. So yeah, I think we can call it a day.
Cool. Thank you all of you for taking out time to attend the session. It was almost, I think, we went over 20-24 minutes, and everybody stood by, and I'm sure we were able to add value. Thank you, Shruti and Ankit, and for taking out time. But folks, I think if you have any other questions, please get in touch with us. We'll be happy to do this. This is something we love to do at Turtle. It's a platform around conversations. More than happy to share details when you get in touch with us. And thank you,
One
Havan,
last
for making
question
all this
about
happen.
Turtle.
Yeah,
One
no,
last
thank you so
question,
much.
Sandeep.
Thank you so
One
much
question
for
about Turtle. Is it
yeah.
only consulting, or do you actually file taxes also for us, or is it like
We
only
can help
consulting?
you. We do help you with that, but the fee I told, and the prima facie, the objective is to build it as a conversation first platform. Anything related to execution, we also help with. You get in touch with us, we'll share the details with you.
Thank you.
Thank you.
Thank you, Raj, Ankit, and Shruti, for taking the time. And yeah,
Pleasure.
Thank you, Avan,
thank
for
you.
having us. Thank you, Raj, for connecting us with Avan and the wonderful people over here. I was very much excited about the quality of questions that has been asked. Some of these questions are actually, it makes you think before you answer them. It's not like a typical answer, but like you just answer and it's done. So we have to think a lot before a lot of these questions. There were some very nice questions, and I love the conversation that I had with so many people over here. And it's nice to be connected with the community that's actually representing India globally. So uh, for me, it's a very proud, maybe an emotional moment. So hats off to you guys. You guys are doing a great job out there.
Thank you. Yeah, I think one thing I can tell about my community that I'm also proud of is they do a lot of research. So I get tons of questions in the community as well, in the groups as well, and it's always fun to answer. And thank you all for attending. I think it was nice to put at least not faces but voices to your names, and hope we can do more sessions in the future as well. Thank you.
Yep. And I think India won. India
Yeah.
Pakistan. So congratulations to all of us.
Congratulations. All right.
Cool. Thank you.
So just one small note, I'll share a feedback form and the recording as well in the group, right? So everyone can access it. All right. Thank you. Bye.
Thank you. Bye.
Bye. Good night.